What if I told you thousands of dead companies and firms that legally don't exist anymore are still wiring billions across the globe? No offices, no employees, no products, yet their bank accounts keep breathing. Who's moving that money, and why is the U.S. government struggling to stop it? Welcome to the hidden world of billion-dollar ghosts, the silent economy that never dies. Today, we'll uncover how corporations that should have been buried years ago are still buying property, funding campaigns, and even manipulating markets. By the end of this video, you'll know how ghost companies launder money, dodge taxes, and distort America's financial system. If you're ready to see how the rich hide in plain sight, tap like and hit subscribe to join the Dark Finance Diaries community. A ghost company is a legal corpse shut down on paper, alive in the bank. These shells are usually set up in secrecy havens like Delaware, the Cayman Islands, or Panama. After dissolution, their names still hold corporate bank accounts, real estate titles, and crypto wallets. Money flows through them because the paperwork linking ownership is almost impossible to trace. Think of it like a zombie, legally dead, but still feeding on cash. Here's how the cycle runs. A wealthy individual or corporation creates multiple LLCs. They register them in states with almost no disclosure laws. Delaware alone hosts over 1.8 million such entities. When one company dies, its assets quietly transfer to another shell. That new shell moves funds offshore, often buying art, crypto, or real estate, turning dirty money clean. Each step hides ownership behind another layer of paperwork. This is legal invisibility, and it costs the U.S. up to $100 billion a year in lost taxes. Remember Panama Papers? That 2016 leak exposed how world leaders hid fortunes through defunct firms. But the U.S. has its own ghosts. Mirror Trading International, a dead crypto firm, kept transacting long after closure. WorldCom and Lehman Brothers bankrupt giants still process residual financial movements via holding entities. Even Trump Organization-related LLCs have stayed active years after dissolution filings. According to the U.S. Treasury, over 30% of suspicious money trails they investigate lead back to dissolved companies. Host money distorts economies. It inflates housing markets when secret buyers use shells to grab luxury condos. It funds political donations through invisible donors. It even bankrolls crime, from drug cartels to cyber fraud rings, all hiding behind inactive corporations. And for everyday Americans, you pay higher taxes, higher home prices, and compete with money that isn't even real. Forensic accountants track these ghosts by following anomalies, sudden transfers, mismatched timestamps, offshore payments. New AI-driven analytics used by FinCEN and IRS are exposing webs of shell entities that span dozens of countries. Yet every time one ghost is exorcised, two more rise, proving regulation always lags innovation. So next time you hear about a company going bankrupt, remember, it might just be reincarnating in another tax haven. Money never dies. It just changes names. If you learned something new today, hit like, drop a smart money in the comments, and subscribe for more hidden economy exposés. This is Dark Finance Diaries, where we follow the money, even after it's gone.
Most people think a ghost company becomes dangerous after it dissolves. But here's the truth. Many ghost companies are designed to die before they ever truly live. Ultra-wealthy individuals and financial engineers set up single-use companies with one goal only: make a transaction, move money, disappear. They exist for a few weeks or months, perform a high-value transfer, then dissolve before regulators even notice. These are known in the secret finance world as burner corporations. Just like burner phones, they exist to leave no trail. One burner company might buy a $14 million condo in Miami, transfer the ownership to another shell overseas, and then vanish, leaving authorities chasing a legal ghost. Ghost companies don't manage themselves. Behind many of them sits a hidden industry of nominee directors, people who rent out their identities for a fee. For as little as $300, someone in Latvia, the Philippines, or the UK will sign your corporate documents, appear as your CEO, take legal responsibility if anything goes wrong. But here's the twist. Most nominee directors run hundreds of companies at the same time, some even thousands. There are nominee directors who've been listed as the CEO of 2,500 firms across 12 countries, even though they've never set foot outside their town. When a ghost company gets caught laundering money, the real owners are invisible, and the nominee director just disappears from the map. Dead companies often list employees who don't exist. These ghost employees serve one purpose: to justify massive salary transfers that are actually money laundering. The scam looks like this. The ghost firm claims it's paying 48 employees. Payroll transfers exit the company each month. The money goes to offshore accounts controlled by criminal networks. No office, no staff, just millions moving under the disguise of normal business operations. Some companies even use AI-generated faces to create fake LinkedIn profiles for their phantom staff, building the illusion of a real workforce. Ghost companies are merging with another threat: synthetic identities. These aren't real people. They are AI-generated names, AI-generated photos, fake addresses, stolen social security numbers of children or the elderly. These people open bank accounts, apply for business loans, and act as corporate managers. According to financial crime analysts, synthetic identity fraud is now the fastest growing crime in the US, and ghost companies are some of its biggest users. America is facing a housing crisis, but here's a hidden factor almost no one talks about: stores, apartments, and luxury homes owned by corporations that no longer exist. Cities like New York, Los Angeles, Seattle, Miami have thousands of properties registered to firms that dissolved years ago. The result? Homes remain empty. Prices skyrocket. Average Americans get pushed out. Ghost companies treat real estate like a safety deposit box, something to store money in, not live in. Some experts estimate that over $60 billion in US real estate is owned by companies that technically shouldn't even exist. Just like people can have their identities stolen, so can corporations. This is how it works. A small business closes. Criminals identify it as dissolved. They reactivate the business using forged documents. They apply for loans, open credit lines, and start transferring money globally. The original owners never know until they get a letter from the IRS asking about suspicious transactions. Ghost companies aren't always created by criminals. Sometimes they're hijacked. Dead companies should not be trading. Yet some ghost firms actively buy and sell stocks through dormant brokerage accounts, inherited corporate portfolios, automated trading scripts. When thousands of these ghost-controlled accounts coordinate, they create artificial price surges, pump and dump schemes, fake market momentum. Financial regulators say a significant percentage of suspicious market activity comes from abandoned corporate accounts used by ghost firms. The US passed the Corporate Transparency Act to expose hidden owners, but ghost companies still slip through because banks don't always verify if a corporation is legally dissolved. Many states don't share dissolution records with federal agencies. Offshore companies can operate in the US through US banks. Global transparency laws don't match, leaving loopholes everywhere. One investigator said it best: trying to stop ghost companies is like trying to catch fog with your hands. Believe it or not, there are firms whose job is to bring dead companies back to life.